We'll do two more problems in chapter 18. This first one, 18.3, Carlotta and Dave form an S corporation. Carlotta owns 75% of the outstanding shares and Dave owns the rest. When the entity's AAA balance is $1 million, meaning they have accumulated earnings, basically, it's sort of like retained earnings. It distributes an asset to each shareholder. The basis of each asset to the corporation is $45,000. Carlotta's asset is worth $90,000 and Dave's is worth $50,000. So the pertinent part about this one, they're asking how much gain does the corporation record and how much gross income Dave and Carlotta are going to have from the results. So you think of this before you start crunching numbers and say, oh, well, let's see how much 90 minus 45. First, you have to say, wait, what's going to happen here? The corporation's going to pay tax on these distributions, or not pay tax. The corporation is going to calculate gain on these two distributions and then distribute it to their owners based on how much each owner owns, not based on which asset they get. So their ownership share is how they get the income distributed. Their distributive share is based on how much their percentage of the corporation is. So we just calculate the gain or loss at the S Corp level, and then 75% of it's going to Carlotta, and the other 25% is going to Dave. So we got 25% times whatever gain we come up with for Dave, and then we've got 75% times whatever gain we come up with for Carlotta. So let's see how much we come up with. I'm just going to calculate the gain right here. Okay, so we have Carlotta. Well, I just want to say asset one. $90,000. And they said both of them had a basis of 45,000. So the gain is also 45,000, right? For asset one. Then we had the second asset. The second one was a $50,000 asset minus $45,000 basis. So that's a $5,000 gain, isn't it? Total gain. 45,000 plus 5, $50,000 gain. So the corporation is going to report on Schedule K this gain of $50,000. And then they're going to take that 50,000 and multiply it times 25% for Dave. To come up with 12,500. That's the answer they want for B. And then 75,000 for Carlotta times the $50,000 gain. So on her K1, she would show this 37,500. The total gain would be the 50,000. So the K, oh, that's not good. So the 37.5 plus 12.5, the two K1s would show the gain of 37.5 and 12.5, and you combine them together on the Schedule K, it's going to show this 50,000. So it's not more complicated than that. It's just, it gets convoluted when you're trying to say, well, Dave needs to report 50,000 minus the 45. So that would be 5,000 for him. And then Carlotta needs to report 90,000 minus the 45. That'd be 45 for her. That's not how it works. The corporation shows the gain and then distributes it out as a flow through or conduit. And so that's how that was going to work. All right. The other one that we're going to do is problem number 18.4. This one had some strange wording, but it's still it's helpful to work through it, I think. All right, so this one said, Sea Green Enterprises reports the following assets and liabilities on its balance sheet. Sea Green just lost a product liability suit with damages of $10 million being awarded to the plaintiff. Although Sea Green will appeal the judgment, legal counsel indicates the judgment is highly unlikely to be overturned by the appellate court. The product liability insurance carried by Sea Green includes a payout ceiling of $6 million. That leaves a whopping $4 million untaken care of, uncovered. So $10 million is the judgment, and the insurance company is going to pay $6 million. And that's going to leave a liability of $4 million. And this is when you want to be a corporation instead of a partnership, isn't it? Okay, so assume any net assets of the company will be used to reduce the judgment. Net assets is not talking about net book value, even though it says the word net. Book value is not really what the assets are worth, right? The assets are worth the fair market value, which is 925 minus 200, 725,000. The reason you have to subtract the 200 we owe to other creditors, and they'll have a claim against those. So we'll be left with $725,000 that we can use to pay part of this. So the question is, for how much of the judgment is the entity and its owners liable if it's these different kind of organizations? So the first question was, if the form of the business entity is the sole proprietorship, the owner is ultimately liable for, and it's a big one, it's going to be $3,275,000. Can't subtract in my head, isn't that sad? And that's just because it is $4 million minus the 725 that they can get from the assets. And that's how they got back to the $3,275,000. If it's a proprietorship, it's they owe for it. So that unless they are independently wealthy and quite substantially so, they're probably going to have to file bankruptcy, right? Because that not everybody has $3,275,000 extra just sitting around. All right, and then the second one, B, if the form of business entity is a general partnership, meaning they're all liable, the partnership and the general partners together are ultimately liable for. Guess what? The answer is exactly the same. I wonder if this thing's going to let me copy this. I guess it'll let me copy the inside anyway. $3,275,000 again. So same deal, because there's no limitation on liability. Now here's the next one. This one is the one I think is confusing the way they worded. C, if the form of the business entity is an LLC, it will be liable for the entire, and the answer is the $4 million. This is why I think this one's a little confusing, because, I mean, why can't they sell the assets and pay for part of it? Not covered by the insurance. However, all the owners of the LLC, and what they're wanting here is they want the word are, because this question said all the owners are protected from all of the LLC's liabilities. So the owners aren't subject to any of this. Therefore, the LLC members have no personal liability. So it's a little lame the way they said it. And honestly, I don't know why they didn't mention that the LLC still could sell the assets and pay down on it. And they would still be only out the $3,275,000, but it would be not the owners. It would be the organization. So it would be a setup for bankruptcy inside the LLC. All right. Now the next one, the C corporation. This is where the beauty of the C corporation comes in. If the form of the business entity is a C corporation, the C corporation has limited liability of their assets. Let's see if I can get it to go over here. Let me go up there. Hang in there. I got to get in just the right place. 925. Oh, sorry. I should have said the total assets that they own It's limited to their assets. The plaintiff, and this is a phrase they want me to say here. It's a lot of words. Will share with other creditors, and I know that, but I just want to see what words they said. Sorry, let's just try to get in the right place. The plaintiff will share with other creditors. And so the shareholders of the C corporation have no personal liability. So this is the beauty of the corporation. In other words, it's not just that they can't get to the shareholders. They're saying even the C corporation's liability is limited to the 920, their assets, instead of the 4 million. I mean, that I don't really, I'm not trying to pretend that I understand about liability law, but I'm just telling you, this is what the solution to the problem says, is that 925 is the limit. So basically what I'm looking for you to understand, oh wait, I'm sorry, the last one, that if it's an S corp, it will be treated exactly like the C corp, because it is a corporation still, and it gets the same shield of liability. So what they're saying is not only are by their answer, they're saying not only are the shareholders protected from liability, but the entity itself has a corporate shield that limits it to their assets. And so that's the part that I don't have enough savvy to understand fully. So we need a lawyer. Where's it, Dr. Coleman? But in any case, you understand what I'm saying. So, but if I ask you a question like this, rather than having the convoluted way of presenting it like they did in C and D, I would rather more likely just ask, where is the shareholder liability stop? What is the max they could lose? And so on the individual and on the partnership, it is the entire judgment minus whatever assets can pay for part of it that are in the business. So that's why it's $3,275,000 for both of them. And then for the LLC and the C corp, the individual investors, maximum they could lose would be their invested amount or their basis in their shares. And so that's the way I would approach it, rather than me pushing the issue on a point that I don't really have full comprehension of why 4 million would be our number here and 925 would be our number here. But I'm not saying they're wrong. I'm saying I'm not going to ask it that way, because that's not really pertinent to the tax question. The tax question we are dealing with is, where's the liability going to fall? And that's what I would expect you to know. Okay, thanks. So we're going to come back another time and pick up some others.